So this news that 91% large cap funds failed to beat their benchmarks over 7 years. I'm sure you've read this news, and it breaks all your hard work, right? I mean, this is a real news we see every other day. And I'm picking news from the last few years only. 76% equity mutual fund schemes underperform benchmarks over 7 years. 119 out of 157 mutual funds have underperformed over the last 7 years. 83% mid-cap funds over underperform. Actively managed large-cap mutual funds are no longer able to give market-beating returns. They're all the news items for the last 2, 3, 4 years. PMS doesn't beat mutual funds in returns despite taking bigger risks. Half of PMS schemes underperform. So this is, you plotted your wealth creation projections, hoping that your investment will be at least beat the benchmark, the market benchmark. But a lot of times, I would say Pareto's rule applies 80% of the times. People will unfortunately discover that you are nowhere close to the benchmark performance and you're falling behind projections also. So you can watch your hard earned money painfully go through frustrating long periods of underperformance despite being in the best of names. So, uh, most popular names Reliance, HDFC, L&T, TCS, Infosys, HUL, ITC, so on and so forth. These are the ones where most of the investors are invested, and you invest in large cap based strategies, hoping that popular quality names will continue to generate similar returns as they have done in the past. So there is a lot of baggage or winners of the past that we try to project in the future, but it may not work all the time. So Reliance, for instance, there was a time when for 10 years Reliance did not perform. There is a time HDFC Bank has not performed for more than 3 years now. Hindustan Levers has been stuck for last nearly 4 years. Asian Paints is stuck for 3 years. I'm just not saying that these are not great companies. These are great companies, but do you have the patience to sit through these long gestation periods, or is there any certainty that at the end of this gestation period there will be growth? Because it's a dynamic world, it's a disruptive world. I mean, you never know when market shares will be taken away, when newer players will come in, or cheaper capital may be targeting some particular company. So it is not about these companies per se. It is not about the index is not doing well. It is about how we are able to extract the strength from the index. Like index is made up of 50 stocks, 100 stocks, 200 stocks, 500 stocks. By investing in an index, we are investing in the strength as well as the weakness of the index. What we want to do is to only invest in the strength of the index so that over a longer period of time, we are able to beat that benchmark. So the whole idea is ensuring that strategy is able to identify winners and ride these winners, and also to ensure that the strategy is quick to identify losers and get rid of the losers. These two powerful themes, when they come together, they create that magic of outperformance versus the benchmark. What do most HNI investors want? They want a robust strategy. Uh, Stocks should be very liquid. Stocks should be popular stocks. Good brands, good companies, fantastic market caps, but also a strategy that can keep beating the benchmark over a period of time. So on one hand, you want safety, security, and the blue chip nature of the market, but on the other hand, you also want the performance to be market beating performance. And of course, when you combine these two, you will achieve gradual compounding to create wealth and achieve your goals. Usually, what happens is a lot of these big names are not able to beat benchmark performance because they are not the strength of the market at all times. And that's where a strategy where, if large and mid cap stocks could be used to create a performance which is somewhere near the small cap performance. That is the real powerful game if you can do that. So that is what that is the most desirable thing, that you have the cake and eat it too, actually, in some ways. So this is what the HNI Capital Compounder is aimed at. This is a new strategy that Weekend Investing is launching within its HNI services portfolio. We've had one HNI Wealth Builder strategy earlier on for mid and small cap strategy, and this completes the bouquet with large cap and mid cap universe as the underlying theme. So this is a strategy that will basically be a rotational momentum strategy, weekly rebalanced. It will have the 20 strongest stocks out of CNX 200 universe, and the core focus will remain on capital protection and wealth preservation. So small cap like project performance in a large and mid cap strategy, it is actually unheard of. But let's walk you through some data. So interestingly, this time what we decided was that we will launch a strategy after we've thoroughly tested it and we've run it live. So that we will not be dependent upon only back tests to lay claim on the effectiveness of the strategy. We've actually run this strategy live on the small case platform since September 2021, and we've had 2 years and 5 months of performance here. Now, I want to first show you what large caps index, CNX 200, large and mid cap index, and small cap 250 index has done in this period. So, in this period from September October 21 till now, large cap CNX 200. I'm calling CNX 200 large cap because it is mostly large cap, but okay, let's call it large and mid cap uh, index. 29.5% is what it has achieved. Small cap 250 at the same time has achieved 60.6%. So, remarkable outperformance by small cap index versus the large and mid cap index. Now, let's add into this mix the performance of the strategy. And mind you, this performance is the live performance. So, this is how HNI Capital Compounder, the line in orange, performed. So HNI Capital Compounder did 81.2% versus 60% of small cap 250 versus 29.5% of CNX 200. So you can see that despite HNI Compounder being a CNX 200 universe strategy, it has not only beaten CNX 200, it has beaten small cap 250 also, and that too by a wide margin. That is the beauty of this product. Another case we have taken with a longer span. Of course, we don't have the live run from April 2016 for this product. But if we were to mix our historical study with the live run and see it over a period of almost 8 years, you will see that CNX 200 has achieved nearly 199% gain, whereas small cap 250 has gained 271% of gain. Now, if we add this HNI capital compounder strategy to the mix, you will see that HNI capital compounder has achieved 386% gain versus 271 for small caps versus 199 for CNX 200. So, both in live performance over nearly 2.5 years versus nearly 8 years of live plus historical performance, we find that there is a great outperformance by this strategy. So the strategy is definitely effective. The quality and robustness of CNX 200 stocks is there, whereas the performance of small caps is also there in this large and mid cap strategy. But how does this work? You will say, how is this even possible? So this is the magic of momentum. While we say magic of momentum is no magic, it is essentially a lot of rule-based, data-based, non-discretionary way of investing. Just to give you a very simple example, let's say there is a horse race and three horses are winning after first two rounds. Uh, Three are in the middle and three are in the back. Who will you bet on? Obviously you will be betting on the horses which are winning after the second round, and maybe there are 5 rounds in the race, so these are the likely ones. At least some of them are going to win, at least in the top 3, top 4, so on and so forth. The ones that are in the back, let's say horse number 18 had won many past races, but right now it is not winning, right? So it means something has changed. Either this horse performance is going down, or the others have done really well versus this. So why will we want to bet on this now? We will not want to bet on this. We will want to bet on it when it shows that it can be in the top 3, top 4, in the top cohort. So that's where the momentum investing difference comes from conventional investing, that we bet on stocks that are telling us that they are upfront, they are ahead of others. Now, in this race, let's say number 8 won the race, but in the next one, the number 8 is not in the front, it is in the middle. We will not bet on it. We will bet on 25, 33, and 44 this time. So in some sense, if you see the analogy with sectors, this is how sectors move from front to back, and there are 10 or 15 sectors that are actively tracked in the market. Every year, IT may not work. Every year, pharma may not work. Every year, banking may not work. Every year, autos, metals, public sector banks may not work. So there is a mix of things that is happening. Sectors are coming to the front of the momentum pack, then going back. Others are replacing them. There is a sectoral transformation that is happening in the market at all times, and you need a strategy that will automatically rotate between these sectors and determine which sectors are the upcoming sectors which are leading from the front, and which sectors are taking a back seat that will automatically get out of your portfolio, and the new sectors will come into this. So, for instance, if you see the actual example of HDFC Bank, it's a very popular example, hence I'm taking it. And this is like last 5 years of data. HDFC Bank in the last 5 years is up 35%, which is not bad, I would say. But ICICI Bank is up 180 or 209% in the same time period. State Bank of India is up 187%. So while yes, HDFC Bank is a great horse, a great stock, but for the last 5 years, I would have rather bet elsewhere. I can come back to HDFC Bank when it starts to perform. Why should I, bet on the horse which won the last race? I want to bet on the horse which is winning the race now. And if I see a very long term period over a decade, yes, HDFC Bank has done very well. For 1400% versus ICICI at 817%. But we want to make sure that we are in the right portfolio at the right time and not lose opportunity cost of our investing. So ride the winners for as long as they have the steam, and we get rid of those winners once they start to lose steam and other winners emerge in the market. And this happens automatically. You don't have to be selective about it. So this is how mostly the momentum strategies or rotational strategies work. And HNI Capital Compounder is another one of this kind. So the aim is to outperform on the upside. When markets are going up, we want to outperform that. And when markets are coming down, we want to fall lesser than the market so that we are outperforming on the downside also. And when you combine the outperformance on upside and outperformance on downside, that is where the real magic, the real compounding will come through. So the core principles of HNI capital compounding are capital preservation and wealth creation. These are two philosophies which are very close to my heart. I don't want to do anything that would, jeopardize capital in the first place. Capital preservation is a must. We must not lose too much capital whenever markets are in a bad situation. The design of the strategies are such, and over a period of time, we should be creating wealth. We can do some risk mitigation into the design of the strategy when we aim for outperformance on upside and we aim for outperformance on downside. Then, when we use a safe and potent blend of established large cap leaders and emerging mid cap champions, we are making sure that we are not into any stock that are fly by night operators, are illiquid, not heard of, not researched, so on and so forth. Then we have a weekly rebalance schedule to stay ahead of the curve. So while weekly rebalance may seem like a short-term game, there are many times when months will go by and there is no change in the portfolio. Weekly rebalance does not mean you are changing stocks every week. It just means that you are reviewing the portfolio every week. And if there is any change, you are effecting that change. Low churn and no discretion to ensure that you always remain invested in strongest 20 stocks. So there is no, as I mentioned, there is no weekly churn mandatorily. There is a churn if and when there is required, and there is no discretion to any rule whatsoever. If the system wants to enter a particular stock or a particular sector, there is no discretion in that. It is built for the long term, aiming for consistently outperforming its benchmark in both bull and bear markets. So this is where we are in terms of the HNI Capital Compounder introduction. Let me show you some performance metrics. Since we went live on small case and as I mentioned earlier also, this strategy has been live since September 21, almost 2.5 years now. It is up 81% since then. The benchmark is up 29.5%. The CAGR has been 27.8%. CNX 200 CAGR has been 11.3%. Max drawdown has been 24%. versus 18%, slightly more than the benchmark as one would have desired. But the ROMAD ratio is better than even the long-term average. So ROMAD ratio is the performance per risk adjusted performance is certainly two times better than the benchmark. Now, if we see the April 16 to 24 period, which includes the live period as well as the historical study, you can see that 386% gain versus almost 200% gain on CNX 200, CAGR of 22% versus 14%, max drawdown at 33% versus 38, and ROMAD ratio is still 75% better at 0.7 versus 0.4. If we see absolute performance from September 21, 100 rupees invested in September 21 is now 181 versus 129 on the CNX 200. If we see from 2016, 100 rupees invested in 2016 is now 486 versus 299 on CNX 200. So gradual compounding and exponential nature of the compounding will happen. You have to come in for the long term. Do not come in for 1 year, 2 years, or 3 years. You never know. We may hit a rough patch in the market for a few years. 3 year rolling CAGR returns is 37.3% now versus 16.9. 4 year rolling returns is now 38% versus 20% on the benchmark. Continuous CAGR has never gone into the red here. It has, in the last many years, stayed above very healthy double digit figures. Annual returns are lumpy. So they will have great years like current year is FY24, 74% versus 30, almost double of, more than double of the performance of the benchmark. And FY21 was 97 versus 73. Another great year, FY22 was 42 versus 20, another great year. And on the downside also minus 18 versus 27 on FY20, and couple of years of underperformance also. FY17 was 27 versus 22. So you will have some lumpy years, some underperforming years, but some really great years. And that's what the entire math will come together. If we see on a SIP basis, on a theoretical basis, if we SIP 10,000 rupees a month on this for the last almost 8 years, you would have accumulated 9.5 lakhs into the SIP. The benchmark would have yielded you 17.9 lakhs. The HNI Capital Compounder could have yielded you 28.5 lakhs. Total trades done since we went live is 162 trades. So 2.5 years, 162 trades, about 60 odd trades per year. So that would translate to about 5 transactions a month, which is nominal in terms of the churn. Uh, Gainers have been 80, losers have been 82. So equal gainers, number of gainers, equal number of losers. You may say, what is the big deal in this strategy when we lose half the time and we win half the time? But the key point is that when we win big. The average gain is 26.4%, whereas the average loss is 9.6%. So this is the magic of even equal winning and losing, because your average gain is much bigger than average loser. The biggest winner, because you allow your winners to run, is 227% gain, and the biggest loser, because you will cut your losses early, is at minus 33%. So these are some of the largest winners: IRFC, VBL, PFC, HAL, BHEL, all in hundreds of percent gain, some of which we are already holding, some we have exited. Can also be situations where we have exited and re-entered after some time. And the biggest losers could be GSW Energy, Trident, ATGL, Vedal, all in 30% kind of range, and so on and so forth. These are the charts of these stocks. The charts are meant to just show that because of a structured strategy, because of rule-based strategy, you are able to enter at highs. Otherwise, in a psychological situation, the human mind does not allow you to buy when stocks are going up. So don't be fearful when stocks are going up. Be fearful when stocks are going down. You will always have to buy when stocks are rising up. These are just examples of all of these. These charts will be available for further viewing also. The recommended capital is 25 lakhs to 1 crore. Subscription fees is 44,999 inclusive GST. We are having some limited slots, first come first serve basis. 17th of March, Sunday at 11 a.m. is when the limited slots will open. These are some FAQs that I will go through in another video, and these will be answered in the FAQ manual that we provide with the product. You can book a call with our team and understand any queries that you have. There is an interest form which is linked below. Please put in your interest form. We will get back to you. We will connect with you. And if required, we will do a live call with you to make you understand any nuance of this strategy. So thank you so much for watching this particular presentation. And I hope that you will make use of the HNI Capital Compounder. Thanks. Bye.